and welcome to the week ahead for the week starting the 1st of December. So not only is this the start of a new week, it is also the start of the final month of the year. But before we get ahead into the week ahead, I'm just going to ask you to take a quick look at the risk warning. I'll put myself on mute whilst you do this. Okay, so as always, just going to have a quick look at what's been going on over the past week, so we have a clue as to where we stand heading into the fresh week. So basically, risk sentiment recovered this holiday shortened week, with US stocks pushing higher. S&P 500 gained around 3.5%, its strongest weekly performance since mid-June. However, tech stocks led the charge higher, with the tech-heavy NASDAQ rising 4.6% across the week, massive jump, and that's compared to a 3% increase in the Dow Jones. Meanwhile, US dollar fell 0.5% across the week, and that was marking its sharpest weekly decline since mid-October. This is the Dow Jones that we are looking at here. As we can see, very solid recovery from that rising trend line support as it's pushing back up towards those fresh all-time highs. Let's just have a quick look at the NASDAQ and what's going on there. Just bear, ooh, why isn't that coming up? Just bear with me 1 second. Here we go, NASDAQ. And again, not seeing the similar same recovery that we have in the Dow Jones, because obviously the Dow's been boosted by that sentiment of the tech stocks, which were just holding back gains in previous weeks. But actually we have seen that the NASDAQ has now caught up with the Dow Jones and traded ahead of it across this week. Now, a lot of the gains that we've seen has been owing to Fed rate cut expectations. These are rate cut expectations for next week. Sorry, it's in 2 weeks' time, the Fed rate decision. But basically what we saw, I mean, this has come down a little bit, but rising expectations surrounding the December rate cut has boosted sentiment, and that's been lifting stocks whilst putting downward pressure on the dollar. Several pieces of weaker than expected data, including softer retail sales and a slump in consumer confidence, have led to the consumer confidence, was at the lowest level since April, and that's just added to expectations that the central bank will reduce rates by 25 basis points next month. This is down, it's at 71%. It was as high as 85% just a few days ago, in fact even this morning, but still, that's up considerably from below 30%, which was where it was just 10 days ago. So that's what's been driving this rebound, this recovery in stocks. Also, the other thing is those concerns over the AI trade have faded, particularly to do with Alphabet, Google parent, which has hit the $4 trillion valuation mark amid surging demand for its new Gemini 3 AI model. So I think, we're still going to see these questions regarding the AI trade and its validation surrounding it. There's been a lot of questions over that sort of circular funding and monetization, and so the market's going to be continue to watch that. But I do think, broadly speaking, that the AI trade potentially is here to stay. But there are those questions over bubbles. It would appear that the market is trying to get over those concerns, which is why we've seen that impressive recovery in tech stocks. Now, we're just going to talk a little bit about seasonality. First week of December, typically a strong month for stocks. On average, the S&P 500 gains 1.5% across December since 1945. However, it's worth noticing that seasonality is usually supportive in November, and actually that hasn't necessarily been the case this November with the S&P 500. Last time I checked, although we may have actually managed to just turn positive, but it was down around 0.4% at the start of trade today. And that shows us that while seasonality is a trader's friend, it is definitely not by any means an absolute. So that's just something to worth keeping in mind. Now, looking ahead to next week, just sticking with the idea of interest rates, there's going to be this focus potentially on a possible Fed chair pick. Now, Treasury Secretary Bessent has been interviewing candidates to replace Federal Reserve Chair Jerome Powell when his term ends in May next year. Now, the shortlist includes White House Economic Advisor Hassett, former Governor Walsh, BlackRock CEO Ryder, and current Fed Governors Waller and Bowman. Now, according to reports in Bloomberg, Hassett has been viewed as the front runner. He's considered a close ally of President Trump. Also shares his stance on more accommodative monetary policy. So should he be appointed, then that could really lift rate cut expectations, particularly regarding next year, which may be beneficial for stocks. I think it may raise some questions to do with the independence of the Fed compared to the president, but that's a different story. I think it may lift rate cut expectations, which would be supportive for stocks, as I said. Just having a look at the technicals on this, we can see that the S&P 500 has recovered from that low we saw down at 6,500, risen above the 50 SMA, above the 6750 level, which was the high in October, and is heading upwards towards the 6920. That's the record high. We do have potentially a bit of resistance around this level here, which is 6850. We're just around that now, but also let's just keep an eye on this momentum. It is a little bit slower. See if we can get across that line, which would be necessary in order for fresh record highs to be reached. Other things to be watching out for, we've got the OPEC meeting on Sunday, so that's this weekend. The OPEC group they are expected to leave the production unchanged. It's an online meeting on Sunday, and the focus is expected to be on longer term issues such as maximum production and establishing capacity baselines for 2027. Let's not forget that the group did increase the oil production for December in the latest meeting, but it did also say that it would put output hikes on pause for the first quarter of 2026. Therefore, we are not expecting this meeting to necessarily have a big impact on the oil price at all. Just having a look, this is the chart for oil. We're trading in this downward channel dating back to July. More recently, we're in this little channel here, which could be a bull flag pattern. We're in a channel, a tight channel, being guided lower by the 50 SMA, recovered off the lower bounds of that channel at 57, rising up now, just coming up. We need a rise above the 60 level. That's the psychological level, the 50 SMA, the falling trend line resistance. So big resistance point there. If we can get above that, then we're going to be looking for 62.50, which was the high in October. A rise above there exposes the 200 SMA. On the downside, levels we're watching out for 57.00. That's on the low for the week. It's also the November low. If we get a breakdown to the downside, that's going to invalidate the potential bull flag pattern, bringing 56 into focus, which is the October low, ahead of 55.30, which was the low for 2025. Also got China ISM manufacturing data on Monday, early on Monday. So that also tends to impact crude oil prices, given that China is the largest importer of oil. So those are things to be watching out for as far as oil is concerned, as well as the Russia-Ukraine peace progress. You know, we're seeing some developments in these talks. There is a sense that they are moving in the right direction. But I think it's also always worth being cautious because we don't really know the timing surrounding this. And, you know, we could see either side pull out at any moment, or you know, just because it seems to be on track doesn't mean it's actually going to go ahead and happen. But if it did, if we did see peace between Russia and Ukraine, then that would increase supply, in the sense that we could see Russia's sanctions removed, which would increase supply to the market, which would add downward pressure to oil prices. If we find that this peace process is going to fall apart, then that could actually be supportive of oil prices. Just next, we're looking at, let's have a see, this is the calendar, oops, a daisy, this is the calendar we've got going on. So we've got, yeah, the manufacturing, so PMIs, that's on Monday and Sunday. Fed Chair Powell is speaking on Monday. That's not actually expected to be regarding monetary policy, so it's not expected to necessarily have a big impact on pricing. And then we've got the US ISM manufacturing PMI, which is expected to slip slightly to 48.6, down from 48.7. It's worth noting that in the S&P manufacturing PMI, for a comparison as well, that fell to a 4-month low of 51.9 in November, down from 52.5. I think this is an interesting gauge because obviously of everything that Trump's been trying to do to get manufacturing back to the US. And so there is a sense that maybe that's not necessarily working, at least in the near term, as we see that index cool. The other thing to point out here is in the S&P PMI, they noted that inventories of finished goods increased at the greatest pace in the survey's 18-year history, pointing to a buildup of unsold stock. So that points to weakening demand. So input price inflation cooled. That's really interesting, to the lowest level since February, meaning that inflationary pressures could be easing in the sector. This is the Dow Jones. I think this data is not necessary, doesn't have a direct impact on the Fed, but it definitely does support sentiment and gives a picture of how the US economy is holding up. Weaker than expected data could just help support those rate cut expectations, although the Fed doesn't really, I think, watch manufacturing so closely. Maybe we'll look at the employment component of the report. But you know, if we get the continued extension of this rebound, then we'll be looking at 48,000 as the next level, ahead of the record high of 48,430. Other things to be watching for, we've got US ISM services. So this is on the Wednesday. We've got a lot of US data next week, which is, you know, given that we've had this sort of data drought for so long, this is on Wednesday, as well as the ADP payroll. So we're getting a good idea of the health of the largest sector in the US economy, together with the ADP employment change, which will be closely watched together with the Challenger report, because there isn't a non-farm payroll next week due to that US government shutdown. But just concentrating on ISM services PMI, expected to just ease slightly to 52.1, down from 52.4. Again, slightly softening in the largest sector of the economy is something that could just support those rate cut expectations, especially if we're seeing the jobs component of the report fall slightly. This is the US dollar. Looking at the US dollar index, okay, this is interesting. So we've seen this recovery up from the level down here, which was the low that we saw, you know, down at 96, the low for 2025. The recovery, it made it up to the just over 100 level. We're back below 100 now. We're also back below the 200 SMA. Wasn't able to sustain a move above the 200 SMA. So we're down here. Levels to be watching out for next, 99. That's the 50 SMA. It's also the low that we saw in middle of November. But if we get weak PMI data, then we could see a continued weakening in the US dollar, which is going to bring that level into focus. On the upside, yeah, if we get a rise above that 100.20 level, that's going to be an encouraging sign for further gains towards the 101.7 level. Now, just going to have a look, as well as that US data, we've got the so I'll just finish with the US actually. We've got US core PCE on Friday. Now this is a really interesting chart, the gold chart, loving this, but let's just talk about core PCE first of all. Core PCE is the Federal Reserve's preferred gauge for inflation. And so following the US government's reopening, the missed September core PCE and personal income spending report has been delayed and will be released on the 5th of December. Just as a point of comparison, the September CPI showed that inflation increased 0.3% month on month. That was lower than the 0.4% expected, whereas core CPI rose 0.2%. That was weaker than 0.3% expected. PPI data showed 0.3% increase month on month, and that lifted annual rates to 2.7% from 2.6%. But the important thing is here is the PPI components feeding into core PCE, such as airline passenger service, accelerated, whilst portfolio management declined. But overall, the relevant CPI and PPI components point to a rather subdued monthly core PCE. So, and this data obviously comes ahead of the December Federal Reserve rate decision, which is due the following week. So yeah, so I mean the rather than yeah, so the FOMC meeting, that's on December the 10th and 11th, where the Fed is expected to cut rates by 25 basis points and is expected to continue cutting interest rates next year. Now, obviously, gold performs well in a weaker dollar environment and Fed rate cut, lower rate environment. So we're seeing this breakout of gold from the symmetrical channel. If we get a rise above or even a close above 4,200, that would open the door to the next move higher towards the record high of 4,381. So we're just at that peak point right now. We break out, we're actually up around 1.2% on the day, and if we get a settle, which it looks like we could, above that 4.2 level, then that's going to be an encouraging sign. On the downside, support, immediate support 4,160, that's the breakout level, sorry, of 4,170, but you'd need to break below the 4,040 region in order to really create a lower low and look towards a bigger downside. So if we get weaker than expected inflation, any sense of cool inflation, any sense of weak data next week, that could help drive gold positions higher. Also longer term, just talking about what's going on as far as central banks, they're considering to buy. I think there was a report by JP Morgan that actually said central banks are now holding more gold than US treasuries for the first time since I think the 1970s. So there's still a lot of central bank buying going on, which is also supportive of the gold price. So I think they're the main points that we're going to be watching out for next week. I'm just going to check. There are a couple of other points: Eurozone retail sales, Q3 GDP, but that's a repeat of a previous. It's not the first reading, so it tends to be less market moving. I think the other one that we should be watching actually, and just to keep an eye on because of intervention watch, is the US dollar, Japanese yen, but this has actually eased away from that 10-month high that was reached. I think it was just at the end of last week, wasn't it? And basically, I mean, what's going here is there's concerns over the fiscal position of Japan, given the dovish fiscal policies of and the expansionary fiscal policies of Prime Minister Takaichi, and also there's been a lot of concerns over the fact that there's sort of sticky-ish inflation, but the Bank of Japan doesn't seem to be too quick on looking to move to hike interest rates. Now, that said, Governor Ueda does speak next week, and there have been has been more of a sense that he could, or the central bank may consider hiking interest rates in December, which could obviously bring some support to the yen. Also, there's been a lot of talk about yen intervention, lots of warnings from the finance minister. Now, they have done it previously over the Thanksgiving holiday. Obviously, that hasn't happened, and we're heading into the final few hours. So that maybe there's a sense that that's not going to happen, at least for now. But levels to be watching. On the downside, you've got 155. So if we get any sort of, weakening of the US dollar, and strengthening of the yen, that's going to be a level to be watching for on the downside. And below there, you got 153. On the upside, buyers, if we're getting some US dollar strength because we get hotter than expected inflation data, because we get solid PMI figures, then that's the level to watch on the upside, 157.90. Yeah. Okay, so, well, that's lovely. Thank you so much for watching and joining us today, and I look forward to seeing you again next week.